Hello everyone, welcome and thanks for watching the Market Report. I'm your host, Marcel Pechman, analyst and writer at Cointelegraph. The show debates the most pressing topics impacting the crypto market, focused on price changes and meaningful events. Today's show first article was written by William Suberg. Bitcoin supply shock will send BTC price to $120,000, Standard Chartered. Standard Chartered, who just last year forecast the Bitcoin price dropping as low as $5,000, now believes it will end the year 10 times higher. Increased miner profitability per Bitcoin mined means they can sell less while maintaining cash inflows, reducing the net Bitcoin supply and pushing prices higher. Listen, I'm a Bitcoin bull, believe me, but the rationale behind this analysis and the price target make no sense. Firstly, miners' profitability has been drastically hurt as the mining difficulty increased by 73% over the last 12 months. But you gotta wonder, well, the Bitcoin price also rallied throughout 2023, so the miners must be doing really good. No, that's not true. Bitcoin's price gained over the last 12 months were 58%, while the difficulty increased by 73%, so their profitability is lower compared to 1 year ago. There are multiple websites where you can easily find the Bitcoin difficulty mining adjustment, which is currently set at 50.65 trillion, and you can see that it increased from 29.15 trillion back in July 2022. So the mining difficulty over the last year increased by 73%. The mining difficulty is kind of a function of the hash rate, meaning the automatic adjustment every 2016 blocks, which occurs approximately every 14 days. The more miners are competing, the higher the difficulty is. So the network compensates to keep the block interval at 10 minutes. So it doesn't matter if there's double the number of miners compared to 6 months ago or compared to past months, the mining difficulty will increase, so miners will take approximately 10 minutes on average to find each block. That's the mining difficulty adjustment. Okay, but let's assume for a moment that Standard Chartered is confident on the 50,000 price target for year-end, which in theory would boost the price by 64% in 6 months. The problem is, one should also assume that the mining difficulty will continue to increase. And we've seen news confirming that the investments have been made. On June 2, Martin Yang said, Bitcoin mining firms keep building despite Bitcoin mining profitably slump. Crypto mining firm CleanSpark has been aggressively expanding its fleet of mining machines this year, despite mining profitability being far from its all-time highs. So there's nothing new here. The miners have been investing over the past months. They'll be adding capacity despite the halving schedule for July 2024. In short, if the Standard Chartered $50,000 year-end price prediction comes to fruition, there might be a 15% gain in miners' profitability adjusted for the difficulty. But that would merely compensate for the loss accumulated over the past 12 months, as the mining difficulty increased by 73% and Bitcoin's price only increased by 58%. Now, let's go back to the articles and Standard Chartered price prediction. Bitcoin should reach $50,000 in 2023, the report from the Global Head of Research and Chief Strategy, Geoff Kendrick, forecast. Therefore, Bitcoin should go on to $120,000 by the end of next year. Okay, so I have two problems with this assumption. First, the $50,000 by year-end seems quite unlikely because the odds of a spot ETF approval in such short time are low, in my opinion. But if by some miracle it gets approved, a potential 5 billion, which is conservative, inflow for those ETFs will likely catapult Bitcoin's price above $70,000. Why? Judging from the price increases caused by the 1.5 billion inflow from Tesla investment back in 2021. In the 70 days preceding the announcement, Bitcoin's price increased by 107% by a mere order of $1.5 billion inflow from Tesla. We're now talking about the leading global mutual fund managers, and given that Canada's Bitcoin ETFs currently hold approximately $1 billion, it would be relatively easy for BlackRock and Fidelity to amass a combined $5 billion inflow in the first 30 days. Having said that, my expectations for an ETF approval by year-end are 10%. So the 50k price target does not make sense. It's too high, too optimistic. It seems a little bit high without an ETF, since we've already gained nearly 20% over the past 30 days, merely on the filling requests. Now, looking at the longer time frame for 2024, the odds of an ETF approval, in my view, increased to 30%. But that causes a problem, because the approval can easily drive the price above $180,000. That's why making a single prediction is not very helpful. You cannot average $200,000 expectation with ETF approval with, I don't know, $40,000 or $50,000 ETF not approval, average it and give it $120,000. That's not how it works. What I can say for sure is that $120,000 prediction from Standard Chartered is awfully conservative if one assumes a 50% odds of approval within 18 months, which is the estimate by Bloomberg analysts. In my opinion, Bitcoin can easily reach $250,000 if Bitcoin ETF spot is approved in the United States. But that also depends on getting at least $10 billion inflows in the first couple of months. Now, on to the next topic, we'll cover an article by Tom Mitchell, Bitcoin halving bullish for Sailor's MicroStrategy, Berenberg Capital. If the historical pattern established by the first 3 Bitcoin halvings continues to play out, with the 4th halving, then the pre-halving rally would begin about 4 months from now. Okay, so there's no basis except data from previous halvings to back this assumption. I don't have an issue with that, but we gotta understand that technical analysis expects patterns to repeat over time, mostly due to psychological factors. Now, what happens when most participants are aware of the pre-halving rally plus the expectation of an ETF approval? People will try to anticipate the movement, maybe buying 2 or 4 months before the usual cycle. In the end, the pre-halving effect may get longer or shorter if investors decide to dump before the event actually happens. But what actually happens during the halving? From an investment perspective, nothing. Alas, quite the opposite effect expected. The tendency should be more miners being ousted from the market due to high energy costs and being forced to sell their stake. If anything, the supply side gets increased in the short term. However, the media coverage is pretty favorable during the halving, either showing how Bitcoin's monetary policy is hard set or focusing on the equivalent inflation now being lower than the precious metals gold. Furthermore, it helps get Bitcoin in search trends and traditional media. In the end, it doesn't matter why the pre-halving rally occurs, but the price impact will obviously be positive. What you should avoid is fixing the timeframes around the event, like 4 months before the event you should buy, because those have changed in the past and will continue to move as traders try to anticipate and maximize their gains using different timing. The bottom line is avoid FOMOing. If you missed an entry spot, you should either dollar cost average by every week, by every month for 12 months, or sit and wait. It is never a good thing to bet solely on historical price movements. Just to highlight, that's my own personal opinion, does not constitute investment advice or reflect Cointelegraph's official view. On our show last topic, we'll cover an on-chain analysis firm Glassnode report on re-accumulation at $30,000. Re-accumulation as usual. In the latest edition of its weekly newsletter, The Week on Chain, analytics firm Glassnode suggested that this was characteristic of Bitcoin price cycles. Bitcoin data often displays strangely repetitive patterns cycle after cycle. In the 21-22 cycle, the 30k price level formed somewhat at a midpoint and was tested several times both from above and below. A very similar level was observed in 2033 and 2018 at approximately $6,500. Bitcoin cycle midpoint comparison. So there's a chart from Glassnode. It's basically showing that there's a midpoint that stands for a couple of years, and it's tested both from above and below. This effect, also known as return to mean, is very common in traditional markets as well. There's nothing new here. When investors are lost without the necessary conviction to move the price, they will refer to the previous 2-year or 3-year average levels. That might be the case just now, as there's conflicting forces from the harsh regulatory environment, namely the SEC suing Coinbase and Binance, sided with the positive triggers on the ETF and Bitcoin halving. Will history repeat itself? Well, history rhymes, but seldom repeats itself. So make sure to have a plan that works if Bitcoin faces another bear market before jumping above $50,000. Well, that's it for today. I hope you guys enjoyed the show. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!